So you've finally decided to start investing. You've saved up a bit of cash. You're ready to make your money work for you. And you log online to see a million different options. Pag-ibig MP2, UITFs, mutual funds, stocks, REITs, digital banks. Suddenly, that excitement turns into a massive headache. Welcome to the world of analysis paralysis, a problem every single new investor in the Philippines faces. There are so many choices. It feels impossible to pick the right one. You're so scared of making a mistake that you end up doing nothing at all. Sound familiar? Well, today, we're going to break it down, cut through the noise, and figure out the best first step for you. Let's simplify things. Think of all these investment options as different levels in a video game. You wouldn't jump straight to the final boss, right? You start at level 1. For most beginners, the investment landscape can be broken down into 3 main categories. First, you have what I call the super safe starting zone. This is the Pag-ibig MP2 program. Why is it so beginner-friendly? Because it's government-backed. That means the risk of losing your capital is extremely low. It's designed to be a simple, accessible savings program that gives you higher returns than a traditional bank account. You contribute money. It grows with annual dividends, and you can get it back after 5 years. It's perfect for your first taste of investing because it's straightforward, secure, and helps you build the habit of setting money aside. It's not going to make you a millionaire overnight, but it's a solid, reliable foundation for your entire investment portfolio. Next up, we have the guided adventure level. These are your mutual funds and unit investment trust funds, or UI. What? Or are these? Imagine you want to invest in the stock market. But picking individual companies sounds terrifying. With mutual funds and UITFs, you pool your money with other investors, and a professional fund manager does all the hard work for you. They select a diverse basket of stocks, bonds, or other assets based on a specific strategy. This gives you instant diversification, which lowers your risk. You get exposure to the potential growth of the market without having to become a stock market genius yourself. It's a fantastic middle ground. More growth potential than MP2, but less hands-on and less risky than picking individual stocks. Finally, we have the expert mode. Directly investing in stocks. This is where you buy shares of individual companies like SM, Ayala, or Jollibee. The potential for high returns is definitely here. If you pick the right company early on, your investment could grow significantly. But, and this is a huge but, the risk is also much higher. Company fortunes can change. Markets can crash. And you could lose a substantial amount of your money if you know what you're redoing. This path requires a lot of research, a strong understanding of the market, and the emotional discipline to not panic sell when things get volatile. It's a great goal to have, but maybe not the best place to put all your money on day one. Okay. Theory is great, but let's make this practical. Let's say you have 10,000 pesos right now, ready to invest. How should you split it? This is where your personal risk tolerance comes in. There's no single correct answer, but let's explore 3 common strategies. First is option A, the safe starter approach. With this, you'd put 60% of your money, or 6,000 pesos, into Pag-ibig MP2. This is your solid foundation. Then, you put 30%, or 3,000 pesos, into a mutual fund, or a UITF. This gives you a taste of market growth with a professional guiding you. Finally, you put just 10%, or 1,000 pesos, into stocks. This 1,000 pesos is what I call tuition fee money. It is a small amount you can use to learn how the stock market works without risking your entire savings. If it grows, great. If it doesn't, you've paid a small price for a very valuable lesson. This approach heavily prioritizes capital preservation while still letting you dip your toes in high-risk waters. It's perfect for the truly cautious beginner. Next, we have option B, the balanced builder. Here, the allocation is more evenly distributed. Finally, there's option C, the risk-taker's launchpad. This is for the brave and the bold. So, which one is best? Honestly, it depends entirely on you. My personal recommendation for a complete beginner. Start with option A or option B. The goal of your first investment isn't to get rich quick. It's to build the habit and the confidence. Option A is fantastic because it protects your capital while you learn. Option B is a great step up once you feel a bit more comfortable. Option C is a path you can grow into, but jumping in headfirst can be a recipe for discouragement if your first stock pick doesn't go well. Now, let me share some real-world perspective from my own journey and from others I've talked to who started small, with around 5,000 to 20,000 pesos. The biggest thing that worked was just starting. The amount wasn't as important as the act of beginning. My first investment was in a local equity mutual fund. I didn't know much, but I knew I wanted to do more than just save. It taught me about market fluctuations, and, most importantly, it taught me the discipline of paying myself first. What are the common regrets? The number one regret I hear is waiting too long for the perfect time or the perfect investment. There's no such thing. The best time to invest was yesterday. The next best time is today. Another huge regret is putting all their money into one single stock they heard about from a friend or a guru. This is a classic mistake. Diversification is your best friend, especially when you're starting out. That's why the portfolio approach we discussed is so powerful. A final warning for newbies: avoid the fear of missing out. You will see stories of people making a fortune on a single meme stock or a new crypto. It's tempting to chase those gains, but it's more like gambling than investing. Stick to your plan. Focus on consistent, long-term growth. Slow and steady really does win the race in investing. The key takeaway is this: analysis paralysis is beaten by taking one small, manageable step. Don't try to master everything at once. Pick a strategy safe, balanced, or risk-taker that matches your personality. Open that MP2 account. Invest a small amount in a mutual fund through an app like Geep. Buy 1 or 2 shares of a blue-chip company. The goal is to get the ball rolling. Once you start, you'll gain momentum. You'll learn from experience, and the path forward will become so much clearer. Investing is a marathon, not a sprint. Your future self will thank you for simply taking that first step today. I hope this helped demystify the process for you. What do you think? Which starting option feels right for you? Let me know in the comments below. And if you found this video helpful, please don't forget to like, share, and subscribe for more content to help you on your financial journey. Thanks for watching, and I'll see you in the next one.